Hello guys, this is Oba FX Trading Academy and welcome once again to my YouTube channel where we do mostly the top-down analysis of different financial securities. And today we're going to be looking at one of the newly added Deriv synthetic index, Volatility 151S index. As I understand, not a lot of people trade the Deriv synthetic indices, but I do have a lot of viewers who constantly call for me to analyze these financial assets. So stay tuned and let's go through this together if you're a fan of this particular index. So like you all know, I like doing my top-down analysis using pure price action trading strategy starting from the monthly time frame. And currently I'm on the monthly time frame. However, one thing that jumps out quickly to us is that we do not have a lot of information on this particular index, and that's because, as I stated earlier, it was added on. If we were to look at this, it was added just most recently, and we can see that it was added on the on I think January, in the early part of late part of last year, and the data that we have here starts from January 2025. So it was added at the beginning of the year. So if we even count the candlesticks that we have, because like I said, on the monthly time frame, each candlestick here represents a month. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, and of course we're in the 10th month of the year. So that makes sense. So the point I'm trying to make is that from the monthly time frame, we do not have the privilege of getting so much information. But however, we do also know that what I try to do on the monthly time frame is to get my directional bias. So let's see, how do we get to do this with the little information that we have? Now, I also like to draw my key zones. And one major key zone that easily jumps out to us on this monthly time frame is this support zone here. Now, why is it very important? We can see that almost every candlestick on the chart got to hit this support before going and was rejected at the support zone. So we can see on the second month the price came down here, it was rejected, price came down, was rejected, and the fifth month we saw the price massively rejected that bettered this green candles. In other words, buyers were able to push the market upwards aggressively up to this point, and then sellers pushed it down to the same support level. So when price got here, the last month, that's the month of September, just this last month, there was like an equal, or there was a battle between the buyers and the sellers that ended up in the formation of a doji candle. However, how does this impact my directional bias? We do know that price had been coming down aggressively, got to a very popular and strong support zone, and then buyers tried to push it upwards. Sellers came into the market, buyers came back in, and we ended the month with a doji candle. A doji simply means that the initial um, um, the initial sellers in control of the market, or if we had buyers in control of the market or sellers in control of the market, it simply means that these people are losing momentum. And in this case, we had sellers pushing price downwards. Price got to a strong support zone. A doji candle appears, which means that the sellers are losing momentum. However, this is the first day in the month of October, and we can see that sellers are gradually trying to still push price downwards. So because of a combination of the strong support zone and the presence of the doji candle from the last month, I'll be partially favoring for now my directional bias to be the upwards direction, because I think price is going to be pushed up from this strong support zone, because I feel, or I believe, that there will be a lesser probability of price breaking beneath this area. But that notwithstanding, the next thing for us to do will be to go to the weekly time frame. Now, on the weekly time frame, let me impute the support area again. The weekly time frame, we can see that we have much more candles. We can see how strong or how much strength this particular support zone weighs. So What we can get from the weekly time frame would be maybe probably the opportunity to add another level here. Okay, another level here. So we have price being rejected from the support zone. Basically, before now, what we get to do on the weekly time frame would be to get like a structure of the market to work with. So if we go to the line graph, we can see that just because of limited information, there isn't really much to work with other than the fact that we have a meaning W formed here, and price is currently retracing towards the neckline of the W. So it would be advisable for us to see clearly what's happening here, because for the past 1, 2, 3, 4 weeks, price was rejected, and we can see that price got back to this resistance zone, was pushed downwards, and sellers, just like I stated from the monthly time frame, are currently pushing the market downwards. So let's go to the daily time frame if we can get clearer structures to work with. Now on the daily time frame, we can see like a structure to work with. Now, how do I mean? If we can see that the market has been making lower lows and lower highs, got into this popular support, this very strong support zone. The market made a, a lower hike, came down, and then there's a structure here. Of course, not just this structure, we can see that market made a higher high to take out this low. However, like I stated from the weekly time frame, we have like a strong resistance zone here. But if I'm to zoom in and I go to the line graph, we can see something here, and this like a clearer picture of the W pattern that we're suspecting from the weekly time frame. And of course, I had explained severally how to trade W pattern. And if we have something like this, this, and then of course this, all we need to do is to wait for a retracement to the neckline, and then we start looking for what? Buying opportunities. And in this case, the neckline would be this area. And as I've explained severally, it's never a given that once price gets here, that price is going to head upwards. So sometimes price gets to come down here. So the pattern remains valid so long as price doesn't take out this level of the W pattern. So that's a simple explanation for trading W pattern. So if we are to apply that here on this daily time frame, so that means our neckline in this case would be this. So if I go back to the candlestick chart, we can see that price is currently at this neckline. So which means that price is within our key zone. And just as we initially favored buying opportunities, or favored that the direction of the market is upwards because it's in a very strong key zone, then we have an opportunity to start looking for what? For buys. So the question would now be, like I always say, how do we take advantage of those markets? The next thing I can do would be first to add my trend line, because as you all know, the three basic tools I like using in my analysis are trend line, support and resistance, as well as what? The Fibonacci retracement tool. So I can as well bring in my Fib to also take it from the swing low to the swing high here. So what we can see here is that price has just moved out of our Fibonacci retracement to golden zone. That's between the 50% and 61.8%. But however, price is reaching down to the 78.2% mark. And aside that, price is currently at the neckline of the W pattern that we just saw. So the question I always like to ask would be, how do we take advantage of this particular setup? Now, the easiest way or the best way would be to wait for the presence of buyers, because as we can see, if we to go to the much lower time frame, let's do that. We can see that for the trend line, price has made several touches of this particular trend line and has been rejected. So if I'm to draw this properly, so we can see price was rejected, came back to the trend line, rejected, formed the neckline of the W, pushed up, and price is currently back to the neckline. So there's a strong probability that price will still come way down to make another touch of this trend line before heading upwards. However, to take advantage of this setup, all we need to do would be to go to the much lower time frames like from the 4 hour time frame, and start looking for the presence of buyers by way of what? More green candles. So this is the daily time frame. This is the 4 hour time frame. I can go way further to the um 1 hour time frame. So I can start looking for entry models. One of them is the what? Counter trend line model. So if I impute my counter trend line here, I can wait for price to clearly or aggressively break above this trend line, wait for a retracement, and then take my buy trade. So this is my own outlook on this new Deriv synthetic index volatility 151S index. So if you trade this, you can use this analysis and compare to yours. If you haven't checked it out and you're interested, you can follow this analysis and check them out. And if you do not have a Deriv account, I'll be attaching a link to this video in case you want to open one and try out these indices. I think I have a very old video on the channel on why you should try out Deriv synthetic indices. So if you're still thinking about it, you can check out the video and see reasons why these are good financial securities to trade. So this, like I said, this is a trading academy channel. This is the first day of October, and our October classes started today. And if you're interested in learning from us, you can reach out by way of the contact details attached to my YouTube channel. If you've gained anything from this analysis, it is only fair that you click on the like button and share with others to gain as well. If you're coming across the channel for the first time, don't forget to hit the subscribe button so that you'll be the first to get notification when subsequent analytical videos are dropped. Thanks again for stopping by my channel. Thanks for watching this video till the end, and have a wonderful and fruitful trading month ahead. Cheers.